From Bloomberg World Headquarters in New York for our TV and radio audiences worldwide, this is a special edition of Wall Street Week, our interview with Brian Moynihan, Chairman and CEO of Bank of America. I'm David Westin. Right now, President Biden is giving remarks. They are specifically about the sanctions imposed today on Russia coming out of the hacking and interference in the election. If you want to follow that, you can follow it on your Bloomberg terminal by going to Live Go. But for right now, we want to turn to the man of the hour, and he is the Chairman and CEO of Bank of America. He is Brian Moynihan. Thank you, Brian, for being back with us here at Bloomberg. So you had some really strong numbers that you reported this morning. Congratulations on those. I want to ask you, though, specifically about what it tells us about the economy more broadly, and specifically about loan origination. I know that's terribly important to you at Bank of America. That was down some. I understand that was partly because people get a lot of money from the government, so they don't have to borrow money. But it doesn't tell us anything about where the economy is right now.
Oh, David, first, thank you for doing this again, and hope you're doing well and staying safe. In the end of the day, the economy affects a big bank like ours, affects the whole banking, the whole financial services system. And so the good news is, this is a healthcare crisis, and the very good news is you're seeing the vaccine numbers go up. You're seeing the ability then to reopen without the risks that the governments can do in the states and cities and towns. And you're seeing people move around. So our spending levels for our Bank of America consumer customer base were record in the first quarter. March is the biggest month ever. If you go back and compare to 19, they're up 20%. And so divide that by 2, it's up 10% a year, which is much faster than they were growing in 15 and 16, 17. So there's a bigger number growing at a faster rate, and yet people still have a lot of the stimulus in their accounts and haven't spent it. So the world still has we have a group of Americans and a group of people around the world who aren't back to work yet, and we need to get that done, whose businesses can't open yet because of the nature of them. We got to get those done. But a big part of the economy, and I think our prediction is for the economy to cross over in the next couple of quarters to be bigger than it was before the pandemic, is open and operating, and the consumers are spending money, and that's very good news. And then when you translate to Bank of America, what you're seeing is our deposits are way up because that money went into people's accounts and it's sitting there. But our loans are not as high, fell largely because people are paying us off because they have so much cash sitting around. So now the commercial side, we expect that to change as the economy growing at 7%, which is what we predict will require companies to borrow to service that economy. It's just that companies had a lot of cash too. So we look for more loan growth as the year progresses. But the good news is the consumer's in good shape. There's an unemployment issue. We got to get that the rest of the way down to where it should be. The businesses got to get open that couldn't be. But by and large, a big portion of the economy is up and operating very well.
Bank of America has a very special viewpoint into the American economy because you have such a consumer, such a retail presence, and also the middle market. You really deal with small and medium-sized enterprises across the country. Are you seeing any pickup in the borrowing from your medium-sized companies yet?
We've seen it bump along the bottom. Usage of our business banking segment, which is 50 million and under revenue companies, and our middle market, which is $2.5 billion, we're seeing the line usage pretty flat. But the good news is it quit going down. We saw in the months during the quarter, January, February, March, it got a little stronger. Our origination activity, meaning new clients and new deals done, is strong, bodes well for the year. But we got to see it come through, and that goes back to those companies having a lot of cash and had to run very efficiently during the crisis because you didn't know what would happen next. And now they're going to be need to start spending money on supplies and things to redo their inventory. Now, the one thing I think we all have to be mindful is we got to get the trade. The trade is growing fast into the country, but the ports and things still need to get straightened out because of just the dynamics of the virus, and the supply chains are still ironing out. So I think one of the things I worry about for mid-sized companies, can they get the supplies to do what they do? So you've heard about lumber prices or resin and things like that. I think it'll straighten out. We hope it'll straighten out. But that's the next sort of outside the healthcare, the next challenge to get the supply chains really up and oiled and greased and running through to serve that fast-growing economy.
So if that is the consumer and the retail side, talk about the investment bank, the other side of your business here. You put up some very big numbers this morning. Can you make up for any shortfall on the retail side from what you're doing in investment banking, and what are you doing to do that?
Well, the investment banking fees year over year up were 50% or something like that, $2 billion plus, terrific. The trading group had, under Jimmy DeMara's leadership, working for Tom Montag, had $5 billion plus of revenue. Matthew Coder in the investment banking side had a great quarter. The activity still seems to be strong in terms of the investment bank, and hopefully that bodes well, carries in the second quarter. Trading always settles down as you go through the year. It's just the way it works, but there's enough activity. So those made up for it. Now the question is, now you'll see more roll through from the other sides of the house because they had to put up big provisions last year because they'll worry about credit. That's gone, and they're taking credits back, and that the deposit base grew, and we can put it to work and finally earn some money. So as the investment bank activity could stay strong because lots of M&A activity has to take place. But if the markets settle down a little bit, that's fine because they've had such a great year. The other parts will roll through and make up for it. But we made $8 billion on $23 billion of revenue, and that's not a bad quarter.
So, Brian, when you talk about settling down, one thing that doesn't seem to be settling down yet are the SPACs, those special purpose acquisition companies. How much of your equity business, because you had a pretty robust quarter in equities, how much of those SPACs, and do you expect that to continue?
Whether it continues or not, it's going to do some of the dynamics, and we do selective ones. We're not as big in the business as other people, and that's fine. And different times we're stronger in investment grade issuance, and other people are stronger in SPACs, and that's fine with us, and we go forward. But it seems to be holding on right now.
Let's talk about yields. The yields have been pushing up on fixed income, despite the fact that this week actually we had a downturn. That may be a flip or not, but it's really important to Bank of America, given the way your business works, what the 10-year yield on this Treasury is and what the yield curve is, the spread between the 2s and the 10s. What are you projecting for the rest of the year? Many people think the yields are just going to keep marching up.
Well, we were all projecting that, and so we were up over the 10-year got up to 170 plus, and now it's back to 155 today. One of the reasons why the bank, companies like ours, took it on the chin a little bit, but that's transient. It'll move back and forth, and there were some reasons for that happening today, I'm told, but we'll see what happens tomorrow. But the reality is, if the economic activity is picking up, and prices are picking up, which you've seen, unemployment's going down, the yield curve will start to normalize, and you saw that start to happen as we came in out of last year, fourth quarter into first quarter. That helps us because as the curve gets higher, we can make more money from the loans and other things we do. Now, what's really important to us, honestly, is short rates. And the question is, when the Fed raises rates, the market has it pretty well deferred, and they've been clear that they want to see the inflation levels Chair Powell's talked about. They want to see the unemployment numbers, and they've been clear about that. The question is whether it will happen faster than they have in their projections, as even they have projections at 6% plus for GDP growth this year. And so we'll see when those rates, but that's the quicker route to success for us because we have all these no interest-bearing deposits that instantaneously are worth more, and we don't have to do any more work.
So I was going to ask you about risks, actually, because right now it looks like things are going gangbusters for Bank of America and some of the other big banks. What do you look at as risks? Is one of the risks the possibility that, in fact, the Fed may have to move sooner than the markets think? Because there are some people who are saying that they will.
Well, the question is, why do they have to move? They have to move because the growth is strong and they're comfortable. The inflation view will hold. Remember they changed their monetary policy to do an average of inflation, and it's the first time we had a chance to put that to work. So I think if they're raising rates because the economy is strong and because the inflation outlook, everything is higher than their targets, that's not a bad thing. If they're raising because inflation and other things got out of control and wasn't temporary, that's probably not a good thing. So, the question of raising rates is a risk in certain circumstances and an extreme benefit in others just because it means the economy is normalizing. If you talk about other risks, there's always a cybersecurity risk. There's always, good deal structuring, credit risk, operational risks, all the types of things you have. But the number one risk to the world still is getting this healthcare crisis behind us because the enthusiasm we feel in the United States and the GDP growth rates have gone from 4% to 7% across 120 days in the estimates out there are due to the path of the vaccine and the miracle of the science that the big pharma pulled off in the United States and drove through and got deployed, getting deployed in people's arms. That is what's giving the U.S. optimism. If that went in a different direction, that's where we have to be careful, and that's the risk we have to monitor more than all the other risks right now. That's the risk that we've got to pursue the vaccine path and get this disease behind it. The war that started last year, we've got to win it, and we've got the ammunition, and we're winning it, and we just got to pursue it and finish it off.
At the same time, that war has been relatively expensive for Bank of America and for others. Your costs have gone up. You've always prided yourself on how you manage the costs at Bank of America. You've had some costs really go up. How long do you think that will continue, the war against the pandemic, and when do you think you're going to return to your cost prudence level?
Well, we told people today that we we had about $1.5 billion costs that we had to add for the first quarter for a whole series of things. Some were accelerating some costs in the future. Some were some things where we changed some compensation plans and caused an acceleration. But and we told people just add that to the $55.5 billion target we had for this year, which had been flat to last year. And that's done. But you're asking a more fundamental question. So that puts us around 57 for the year. Have we told people that? But the reality is when do the costs come back down? Well, the good news is we're seeing the headcount in the companies flatten out and start to come down again. We had to build major amount of resources for the PPP program, for the EIP distribution programs, to handle the call volumes because we had branches closed and people called more often, especially with all these payments from the government and stuff. So those costs now are starting to tip over. We had to raise costs in anticipation of whether the credit collections and other things would persist. They went away. So you'll see that over this quarter and next quarter. But the good news is the headcount was down slightly in the first quarter, managed through attrition. And those costs are going. And then the costs we did are good things for our teammates. We gave $100 a day for people to hire people, take care of the kids so they could do a great job for their customers. We funded 3.7 million days of child care for our teammates. That benefit, as schools go back in session and summer camps open up, will normalize down. And that's the type of thing. But it was the thing we had to do to preserve the franchise and make it operate well. That's why we have more customers. That's why we have better customer scores. And frankly, why we have better employee scores than we did before the crisis.
So, Brian, that's the cost of Bank of America settling down. Let me ask about growth settling down. Right now, a lot of the projections, and I'm curious about where your projections are now. You've given projections in the past, what the GDP growth will be this year. But will that continue? Are we seeing potentially a change in the long-term potential of the economy, or will that settle back down in a year?
Well, right, that's kind of the interesting thing, David. You're asking a very interesting question there isn't a lot of discussion about. But if you're sitting here, after our October earnings report, for 2021, the prediction for growth would have been 4%, having come off of a third quarter last year of a recovery of 30%. And it was sort of 4%. But year 22 was sort of down in the 2-3 range. What's happened is 21 has been raised up by our team up to 7%. But the big news is they've raised 22 up to 5.5%. That is due to the additional stimulus, the pace at which people are coming out, the fact that the vaccine works and is getting in people's arms and is seemed, frankly, easier to distribute than I think people thought at the time. So that's the major change. So you're putting your finger on it. If this works the way the economists who study this hard, and our team is one of the best in the business, if it works the way they're saying, you're going to have another year of really outsized growth. Because remember where we were in 17 and 18 when the tax reform came through and everybody thought there'd be explosive growth. We didn't even get to 3% then. And you're saying I'm going to have a 7% year on an economy which is about the same size or slightly bigger by year end, a 5.5% year, and then we'll see what follows on because people don't go out that far. That is a lot of economic activity in a huge U.S. economy. And that's going to be the interesting question. If we fulfill that, we're at a different place, frankly.
It sure is, and I'm curious about that because a lot of the stimulus was not going in investment that you would normally think would increase productivity. Are the projections you're making before you get to a possible stimulus package of perhaps $2.25 trillion?
Well, I mean, in the next stimulus, there's been a lot already.
Infrastructure.
I don't think our estimates on an infrastructure stimulus, I don't think those estimates have a lot in for infrastructure, only because A, it takes time to get that money deployed, and B, it's still got to take form and shape. So the estimates they have are off the last stimulus and the one before that. But so I think there could be room for upside, and I think that if that happens and it's aimed right, it should provide the productivity and work if it's aimed in the right places. The best news about the economy, honestly, is the unemployment rate keeps coming down. The new claims today came down again. It's normalizing as restaurants can open fully, and those of us that live in the upper part of the United States, it's been pretty cold to eat outside and things like that. So as you can actually eat outside and it's warmer, the travel and entertainment industries, hotel bookings, and our commercial side charges, our merchant business and in our consumer, you can see those up 30-40%. So you're starting to see people move and travel. Those are all good things, and that'll bring down employment. That's very good news because that means we can actually get people back to work, and then we can worry about reskilling them and giving them other jobs. We got to get people back to work. back down to the more normal 4% unemployment, or not more target 4% unemployment or so.
Brian, you've always prided yourself not only on being able to control costs, but also control risk, manage risk. You talk about responsible growth for Bank of America. We've had some instances in the recent past of some other banks that have raised questions about managing risk. I'm talking, of course, about Archegos. I understand from your chief financial officer that you weren't involved in that. But knowing you, when you first heard about that, did you ask Tom Montag, others, to say, do we have any exposure, not just to Archegos, not just to that one, but to other similar ones? How do you know that you don't have that kind of risk?
Well, that's a case, but every one of these cases, whether it's operational things that happen or in that case, a lending arrangement, a prime brokerage type arrangement that goes awry, whatever the case is, look, we don't think we have all the answers at all. We immediately say, could that have happened here? How do we know it didn't happen here? Let's go double check. Let's recheck all our systems and make sure, et cetera. Cybersecurity attack, whatever the case is. And so one of the ways you have to be curious. You have to ask the question. If you think, whether it's even on the competitive side, new products, new services, what's out there, what do customers need, you have to be curious. But also on the risk side, and Jeff Green, our chief risk officer, along with Tom and Jimmy DeMar and the team in the lending side, a fellow named Robert Schleicher and Bruce Thompson and Mick Ankrum, these guys, this team and Cheryl Boucher, and this team is just very good at understanding risk. And so sometimes the opportunity is that you take it, sometimes you don't. But whenever anything happens, you've got to go in and look and say, okay, let's not act like we're too smart. Let's not think we're too smart. Let's have serious doubt about how good we are and go look at it and confirm that it didn't happen instead of saying it couldn't have happened because. And that's the way you run good risk management.
You had an extraordinary experience at Bank of America. Others did as well, where you had to go to work from home almost overnight with an awful lot of employees. You gave a lot of support to those employees. Is it necessary to bring them all back? And if so, do you need to give more support in that process?
Well, I think let's think about it a couple ways. One is our teammates want to work, and we're a work from office company because of productivity and the culture and the mentoring that can take place is just better. Now, maybe that changes over another couple decades. Maybe if we were in this condition for a decade, we'd have to adjust. But in the end of the day, we are already saying to people, you got to get, you get your vaccines. We get half the people in the office vaccinated. You can open the office, and we're having people trying to get through that window, in some of the field office and stuff. So we're letting people make their decisions. We're encouraging them. We're showing them lots of data. We're trying to get appointments for our team and things like that so they can get back to work. And then we're a work from office company. Now, we are already in the mode of high-performing workplaces and sort of hoteling office and all the different discussion. We think people will think about commuting differently. I always tell the story that we had our big buildings in Midtown at One Bryant Park, and we're doing a building across the street. And when we ask people to move to Jersey City or something like that, they might think, oh my gosh, you're sending me to outer Mongolia or something like that. The reality is they now have gone from home and they're much more adaptable. Well, I'll commute in the city a couple of days. I'll commute, to Jersey City, or I'll go to Hopewell. So we have to think about our real estate configuration and retool it. In the end of the day, 10 years ago, we had 130 million square feet of real estate for Bank of America. Today, we have about 70. And so we can just keep making that real estate more efficient and more dedicated team, better real estate for our teammates to work in, and then work with them on their personal decisions. But at the end of the day, we have found in our work from office strategies, work from home strategies, which we've had for years, that certain types of jobs and certain types of activity are better served. And we had about 20,000 people working from home before the pandemic, but it has to be a certain type of job and a certain activity, and we'll see how that plays out. But my big expectation is after Labor Day, we'll be back to generally moving towards being back to normal. Between now and then, it'll be partial. But the key is then you flip it for the good of cities and towns and stuff. As those people who are vaccinated come back to work and go to restaurants, that'll just be good for the vibrancy of downtown. So in Charlotte, I was talking to another CEO today. We need to get the people commuting downtown, and then the restaurants and downtown life can come back. And great cities need that.
You've got a lot of real estate in Boston and in New York and in Charlotte. Are you going to have more in Florida? Because we're seeing a fair number of financial institutions that are moving south. Is that on the table for Bank of America?
Not really. We would, our operations are pretty well sited where they are. And by the way, we have a lot of people in Florida and a lot of people in Jacksonville and places like that, the big operation centers for years. So, we're largely sited where we are. We don't see that. Our new kids, I think, I was thinking about New York the other day. We have kids that came to work at Bank of America and our New York offices in 19, 20, and 20, and a new class coming in 21. And by the fall, think about the kids that came in mid-19, they only spent 6-8 months in the office and then went to work from home. The 20 kids never came in. The 21 kids we're only hiring now. All those kids will be descending on New York, and that once we get them vaccinated, we'll bring them in the office in the fall, and think about the dynamics of New York. And so, having them together, having them learn from each other, having them engaged, the camaraderie they develop, and the camaraderie they do by walking down the hall. We need to keep critical mass in the places we are and get the people to work.
Let's talk about social values. That's another thing you've prided yourself on, the way you express your social values. As I understand it, you've expanded your commitment to pursue racial equality and economic opportunity from $1 billion to $1.25 billion now. Various investments you're making around the country with people who really need it. You now have an invitation, a kind invitation from the Congress, both the House and the Senate, to come down and testify with your fellow CEOs. I don't know what they're going to ask you about. Maybe you know, but I think they might say, boy, you're making a lot of money. What are you doing for the people who need it the most? What are you going to tell them?
Well, there's a couple things about that. So first start about, what do you directly have control over? That's the people you employ and what you do with your first. And so we start, during this crisis last year, this time, we finally completed the move from $17.50 to $20 an hour, or 18, I think it was, to $20 an hour, and closed out in 4 years what we were going to do in 5 years. So we start every job in our company at $20 an hour. Our teammates get full benefits, full 401k, match, and everything. For the people, we stratify our health care benefits by compensation level, so people under $50,000 haven't had a change, had their premium, for lack of a better term, or self-insured, but their premium drop in half in 2011, and it's never gone up. The same price, even though there's been a 6% cost to carry. And we've done that by getting more and more people well and being able to afford it. So we reinvest that back into people. So we take great pride in that. So we employ a very diverse population from top to bottom. We hire a lot of people. We have specialized programs like our Pathways program, where 10,000 people we hired in from low and moderate communities, veterans, women. We do a lot with schools and recruiting that are very broad. So that's one thing we know we can control, is who we hire. Then we have our vendors. We require them to pay $15, and we've been moving all of them up to do that because we think they should be able to do it, and that's what we say. Then you go to what we do outside, and that's more what you're talking about. So after last year and the racial social justice issues, after the George Floyd killing and the other killings and what happened, we basically made $1 billion commitment. We did three things. We denounced racism. Second, we gave a foundational grant to the Smithsonian Institute to start a courageous conversation platform with Lonnie Bunch at the Smithsonian across African Americans, Native Americans, Hispanics, and Asian Americans across all their platforms. Then we put a $1 billion program together along the pillars of jobs, health, small business entrepreneurship, and housing. And we have now deployed about $350 million of that. As we move through the year, that money went to the minority deposit institutions. We've done about 14 of those. To the things called the CDFIs, we kept our levels up. That's not even part of the $1 billion. That's above. We have $1.7 billion with them. We put money into 21 colleges and community colleges to help HBCU colleges, four-year people, helping to get jobs with big companies like ours, and then community colleges, skill set, an entrepreneurship center in Atlanta with the Black Executive Alliance and Morehouse and Spelman. And then we did 25 million masks delivered to community centers and to help keep people safe. Then we did 61 private equity funds coming up from all our market presidents, bringing them to us, and that's all done. And so now, then we have the Asian American, people of Asian descent, Pacific Island descent issues come up, and we said, look, we've got to dedicate even more and expand the dollar amount of this program, and also make it clear that we're covering those colleagues and teammates in society, and we've done that for $1.25 billion.
Yeah, it sounds like you've got your testimony pretty well written for you already, just as soon as you got the invitation. I want to ask one question about crypto, because it's come up quite a bit. I mean, you and I have talked before about Bitcoin. You always say it's not Bitcoin, it's blockchain, it's distributed ledger. At the same time, we had the chairman of the Fed talk to us just this week and say, it's not cryptocurrency, it's crypto assets that you speculate about. How do you see the dynamic from Bitcoin on the one hand to cryptocurrency of any sort of the other, to perhaps a central bank digital currency? Where is this going?
Well, I think there are multiple facets. Obviously, as an asset people are investing in, our clients are asking us, can we invest in this asset and put it in our accounts and look at it. And those are issues we have to consider. And you're seeing, some of our colleagues start to do formal custody, and you've seen those announcements and things like that, which will enable us to do some things. And so that's the investment side, and that's for large institutions and affluent investors and people looking at it. Then you have the transactional side, and the question of moving money digitally is not new. More than, I think, probably 55-60% of our consumer money moved digitally this last quarter, and on the commercial side, it's probably 97%. It all moves digitally, very little paper movement. So the idea of moving money digitally, think about Zelle and the volumes going through that now, and the number of users, not only in our company, but in the industry total. That's not a new concept. Then the question is, an anonymous currency or currency that doesn't have attribution. That's a different question, and I think you've heard Chair Powell and Secretary of Treasuries in the past reflect on that. That's a different question. A central bank digital currency, is just, we already, anyway, we already have that. We have a bunch of accounts with them. They're ones and zeros. We know where they are. There's a huge amount of money represented by it. So the idea of making it available more granular, I think we'll see what they decide to do, and we'll react to it. But the reality is we make money movement digitally is the dominant way money moves in our franchise today, and it will be in the future.
Brian, just one quick one here at the end, if you can. Was it hard to decide to sign on to that level about the Georgia voting law? Because you signed with a lot of other companies protesting what's going on.
Well, we'd made a statement a few weeks ago, and then we were approached to sign along with all those other companies about the basic fundamental principle of voting and the right to vote. Now, David, as you watch this play out, I looked back in history, and some of the
Brian, I'm so sorry.
Thank
you so much. For our TV and radio audiences, this is Bloomberg. Thank you to Brian Moynihan, CEO of Bank of America.